Hello, Mark Sturdy with highlights of 7 Days Ahead's weekly technical analysis, written on Monday morning, talking and recording this on Tuesday evening. In the summary, we are bullish of the dollar or more particularly, bearish of the euro. Bearish of the euro against the dollar and sterling. Quickly go through the reasoning behind that. The pressing down of the euro against the dollar from this pattern, it has actually almost reached its minimum measured move. Doesn't mean to say it's a turning point, but we can expect a diminution of bearishness from here onwards, 109 down. But nonetheless, the market does look under pressure still. More to come, we think. We were bullish of sterling against the euro. And the reasoning for that was a possible breakout of this trading range, long-established trading range since 2016, the break and close above the 120.41 in the week. There is some volatility around this level today. We're rather lower, so that should be closely watched. We want another close above that 120.81 level on the week, and in particular 120.41 on the month. So that should be closely watched. Turning to stocks, let's look at the summary there. We are flat in the S&P 500 and bearish of the Euro Stoxx 50 and relatively bullish in the Nikkei 225. Let me just go through those three. The reason we're flat in the S&P 500 is that even though there is the possibility of a nice, let's look at this weekly chart, head and shoulders top, we have not closed beneath this neckline yet, and nor have we this evening. So it is pregnant with bearish possibilities, but we have not had the trigger close beneath this possible neckline, which is beneath 4,200. I should just add that I've just checked the live market at 9:20 on Tuesday evening, and in fact we are now trading between 4,200. Were the market to close there tonight, and it is extremely volatile, that would trigger another big bear move in the S&P, and we would obviously be bearish. So watch closely for the close tonight and the open tomorrow morning. If it's below 4,200, that's say on Wednesday morning, it will be a good sell. That will trigger the bearishness. We were already bearishness of the Euro Stoxx 50, and the reason being that it had penetrated beneath these prior high supports, these horizontals, going all the way back to 2015. The weekly chart shows the breakdown of this small top formation and some support there, but the implications of this very long-term breakdown are for all to see, and there's no clear support beneath the market. This is a monthly chart, so we need to have the close on the month, and it's just possible we close above 3,700, above this level here in the weekly chart. But the implications of this market closing beneath 3703, 3700 are pretty grave for the Euro Stoxx 50. Compare that to the Nikkei 225, where we are relatively bullish. The reason being that we've pulled back to the neckline of this massively important complex, that is to say double-headed, double-shouldered, head and shoulders reversal that has been created over many years, going back to the 1980s. So we see 2,500 as a major level of support, 2,400 down here. The market has not broken that yet today. It may tomorrow, but it hasn't yet. And so until that breaks, we are bullish. There is a double top in place in the weekly chart, but we are watching carefully this chart here. And while this has not broken, it is the market is in reasonable fettle. Clearly, we have the situation here of a medium-term bearishness and long-term bullishness, and it remains to be seen as to whether the market can, using this medium-term top here, it can penetrate this and close beneath on the month. Well, actually, this is quarterly, or whether it can go down and then bounce back up. All I can say is that, relatively speaking, the technical setup of the Nikkei is dramatically more favorable than either that of the S&P or the Euro Stoxx 50. That's the takeaway. Turning to the summary for bonds, we're bullish of yields, higher yields in both the T-note and the UK gilt. Let's just look at the T-note as the pathfinder. The market has fallen, yields have fallen since the emergency broke out, but they have so far found good support. And we would not be bearish of yields unless this 107 were broken conclusively, and then this bull continuation triangle collapsed. On price terms, we would need to see the market above 129. That may yet happen, but it hasn't happened yet. Oil and gold, well, here's a drama. Oil has obviously gone bid, as we see, pushing up above these prior highs, 115 to 110. Let's look at the weekly chart. There is, in my view, a head and shoulders reversal there. But it is a difficult one, and it is not perfect. If it is a head and shoulder reversal, it calls it up to 150 or so. You see here the measured move. Because it's sketchy, because the structures aren't perfect, it's difficult to trade. And we are bullish, but it's a very difficult market to trade in terms of using levels that were established a long time ago and aren't, strictly speaking, useful pointers. Gold is easier than oil. It's moved rather less thus far, but I think it's an easier and more intelligible piece of technical analysis. The market, obviously, we know has this long-term pause at the prior highs of 1915. That has now changed with the completion of this double bottom, which calls the market up to 2200, in my view. The market this evening is up at this level here, this prior high, has been up to this prior high and is slightly lower, so it's down here. It's a buy if it can come down to 1950. It's probably a buy here. This is a good completed double bottom formed from the prior high on the basis of the support from 1704, here, 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 and here. This is a bull market. I think it will go as far as 2200. Thanks very much.